Hello, everyone, and welcome to another episode of the Market Snapshot series. My name is Rufus Kamau, Markets Analyst at FXPesa. So today, we'll be talking about the top events that we are expecting to be impacting the markets today. We'll also be talking about the key highlight, which is the US retail sales. We'll try to understand what it is and how the data may impact the US dollar pairs, gold, silver, as well as equity indices. So once you join in, kindly say hi on the live comment section, and these will confirm that everything is working just fine. So as always, this session does not constitute of any form of investment advice. It's not a recommendation to trade. So you should always do your own due diligence and practice proper risk management. So before we get started, I would like to mention that on the Bullish Banter podcast, especially for the fans and listeners we have on this live, make sure that you you schedule a date on the 21st of February, where we'll be having the second event of the year. So our second event of the year will be on when 21st. I'm just trying to find the link so I can share with you guys. Just give me a sec. I want to take a sec, and then everyone will have the link. Should be on my profile somewhere. Yeah, so it should be on FXPesa's page, as well as the Bullish Banter page. The link to subscription. I'm going to copy the link and then paste it in the comment section. So on the specific event, we'll be settling the ultimate debate. Does trading your own money on your own live account create better traders than trading on prop firm models? So if you have your, let's say, $100, should you put that amount of money in a prop firm trading account, or should you put that money in your live trading account and trade yourself? Which one is better? Which one applies best to you? So we'll be inviting some of the top traders in the country. We will be inviting the top icons in the markets on a panel, discussing various investment trades, including different markets from US to Kenyan markets. We get to discuss all this. So make sure you book your seat. It will be within Nairobi. So from then, we'll be able to discuss and have a lot more conversations around the markets, and everyone gets to benefit as part of the community. So the link is in the comment section, so make sure to check it out. And now that that is behind us, let's move on to the next thing. And that's the US retail sales data that we're expecting this afternoon. So on the US retail sales data, we'll begin by trying to understand what it is. So first question, this is Investopedia. Retail sales, what is it? How is it measured? And how do you use it as an economic indicator? So retail sales are an economic metric that tracks consumer demand for finished goods. This figure is a very important data set, as it is a key monthly market moving event. Retail sales as reported each month by the US Census Bureau and indicate the direction of the economy. It acts as a key economic barometer and whether inflationary pressures exist. Retail sales are measured by durable and non-durable goods purchased over a defined period of time. Sales for the report are derived from 13 types of retailers, from food service to retail stores. So, in a nutshell, the US Census Bureau will do this every month. And what it does is that it tracks sales from some of the top retailers in the country. This includes supermarkets like Walmart. They look at online merchants such as Amazon. And then they will bundle these into one statistic. So this way they're able to know how much retail goods people are purchasing every single period. So the last detailed data we got was in the month of November, and it shows an uptick in retail sales. So why is this data important? The data is important because you're able to track how much money people are spending. And if people are hopeful about the near future of the economy, they tend to buy more stuff. So if they are not hopeful, they tend to buy less stuff, and this can be a very good economic indicator of how consumer spending trends are moving. So retail sales are a good indicator of the pulse of the economy and its projected path towards expansion or contraction. Retail sales figures are reported by all food service and retail stores and compiled by the US Census Bureau. The measurement is typically based on data sampling and is used to model the patterns of the entire economy. So as a leading macroeconomic indicator, healthy retail sales figures typically elicit positive movements in equity markets. Higher sales are good news for shareholders of retail companies because it means higher earnings. Bondholders, on the other hand, are quite ambivalent towards this metric. So what this basically means is that if, let's say, you get the retail sales reports today, and it shows that in the month of December, American consumers were buying more and more stuff, and the retail sales are better than expected, then it means that those stuff that people are buying came from companies. So those companies made more sales. So the data tends to be positively correlated with the US equity markets. So if companies sell more, then you expect them to make more profits. And as a result, you expect the share value to be moving higher. So it's also positively correlated with the currency. So when there is more retail sales, there is more demand for that currency. And as a result, we tend to see the currency positively correlating with the retail sales data. So a booming economy is good for all, but lower retail sales figures and a contracting economy will translate to a decrease in inflation. So this may cause investors to gravitate towards bonds, eventually leading to higher bond prices. So retail sales capture in-store sales as well as catalog and other out-of-store sales of both durable last for more than 3 years, and non-durable goods, those with a 3-year or shorter lifespan. So by dividing retail sales into two, durable goods and non-durable goods, you're able to track how exactly people are spending their money. So durable goods are goods that last well within around 3 years and above. So for instance, it's not every day you buy a new car. It's not every day you buy, let's say, new furniture. It's not every day you buy new electronics like refrigerators, and many other electronics. So normally, when there is economic stress or things are not doing really well in an economy, people will buy less durable goods, and this is usually the first red sign in an economy. So you won't find a lot of people buying TVs when the economy is doing badly, but then for non-durable goods, these are things like food, clothing. Tend to uh, they tend to be consistent over time. So no matter how badly the economy is doing, you still buy milk, you still buy bread. So non-durable goods basically show the overall level of liquidity within people's pockets. But durable goods tend to have more impact. So retail sales capture, sorry, I think we've already covered that. So the categories include but are not limited to clothing and clothing accessories and stores, pharmacies and drugstores, food and beverage stores, electronics and appliance stores, furniture stores, gasoline stations, and new car dealers. So as a broad economic indicator, the retail sales report is one of the timeliest reports because it provides data that is only a few weeks old. Individual retail companies often provide their own sales figures at the same time every month, and their stocks can experience volatility as investors process the data. So major changes in price can affect retail sales figures. These fluctuations in prices are seen primarily in two retail sales categories: food retailers and gas stations. Large increases in food and energy prices can cause sales figures to drop in both categories, thus affecting the sales of a particular month. So as of the latest data, the retail sales in the US in the month of, sorry, this is not the latest, this is November 2024. It was $725.9 billion, which was an increase of 0.8% from the prior month. So these figures are seasonally adjusted, but not adjusted for inflation. So now let's look at the most recent data. And here we start with the durable goods orders. So new orders for US manufactured durable goods jumped 5.3% month over month in November 2025, rebounding from a revised 2.1% decline in October and beating market expectations of a 3.7% increase. So the gain was driven by a sharp rebound in transportation equipment orders, which surged 14.7% after a 6.3% fall in October, led by a 97.6% spike in civilian aircraft bookings. Elsewhere, orders also rose for electrical equipment, appliances, and components, which was up 1.7% compared to a drop of 0.5% in the prior month. Fabricated metal products were up 1% versus 0.8% previously. Machinery up 0.5% versus 0.6% growth previously. And computers and electronics were up 0.2%, where in the prior month it was unchanged. So excluding transportation, new orders increased 0.5% after a 0.1% gain in October, while orders excluding defense surged 6.6%, reversing a 1.3% decline in the prior month. So as you can see on this graph here, there has been out of variations month over month. For instance, in March last year, there was a 7.6% increase, then a drop in April, a big gain in May, drop in June and July, then gain in August, a small gain in September, drop in October, and then a rise in November. So now we'll be looking at the December 2025 data. Remember, there was shutdowns which impacted the data and how frequently it was reported. But then overall expectation is that we get to see a much higher increase in retail sales, especially for the month of December, which tends to have more purchases. So overall, if you look at the overall US retail sales, now this is combining durable and non-durable goods. Retail sales were up 0.6% in November. This was the largest gain since July, rebounding from a revised 0.1% decline in October and exceeding forecast of a 0.4% increase. The rise was driven by a rebound in auto sales, following a slowdown caused by the expiration of federal tax incentives on electric vehicles, and by strong holiday shopping. Biggest increases were seen in sales for sporting goods, musical instrument and bookstores, miscellaneous store retailers, gasoline stations, building and garden suppliers, motor vehicle dealers, clothing stores, and food services and drinking places, non-store retailers, health and personal care, and food and beverage stores, which had the smallest gain of 0.1%. So on the other hand, sales were flat at general merchandise and electronics stores, which fell 0.1% at furniture stores. Meanwhile, sales excluding food services and auto dealers, building material stores, and gasoline stations, which are used to calculate GDP, were up 0.4%. So clearly, after 4 months of decline from June, actually it's 5, from June, where we had a 1% increase, this dropped to 0.6, then 0.5, then 0.1, and then a drop of 0.1%. There was a sudden uptick in the month of November, which gained by 0.6%. So we will be expecting to see the data later this afternoon. So on the economic calendar, here is the projection that we have. So just give me a sec. I need to update my filters here. So the data will be coming later on today, being the 10th of February. 4 days before the Valentine's Day. Wish you guys a happy Valentine's in advance. So 4:30 p.m. is the exact time when the data will be released. So as per the previous reading, we had a 0.5% increase in core retail sales. So core retail sales are basically retail sales that exclude automobiles. Automobiles can cause volatility in the data. So when you strip automobiles from the data, you get a much smoother curve. And here we're expecting a 0.3% increase in the month of December, which would be slight slowdown from the previous reading of 0.5% increase. So on the overhead retail sales month over month, we're expecting a 0.4% increase in the month of December, which will be a slowdown from 0.6% in the prior reading. And now that we know what the retail sales is, and we know how these data correlates or impacts various markets, let's try to understand what this means. So this means that at 4:30 p.m., if we get a number that is much higher than the projections, for instance, let's say retail sales data comes at 0.6%, then that would mean that the data came better than expected. And then we'll be expecting a positive correlation with the equities market as well as the currency. So this would likely mean that we get to see a much stronger dollar compared to other currencies. And we also get to see a much stronger US equities market. With key focus on indices, we should be seeing a positive rally in the SP 500, in the NASDAQ, as well as the Dow Jones, and also the Russell 2000 index. So that is in the case of better than expected retail sales. So the opposite is also true. So for instance, if retail sales come in lower than 0.4%, it means that the data has missed expectations. So we should be expecting a similar negative correlation, where we could be seeing a much weaker dollar and much weaker US equity indices. So that's one way of interpreting it. So on the focus of the dollar, that will now directly correlate with the market for gold and silver, where if retail sales happen to be positive and the dollar strengthens, remember gold is valued in the dollar. So a strong dollar would mean a weaker gold, weaker silver. On the other hand, a weaker dollar would mean a stronger gold and silver. So that is my analysis for the retail sales report as of this afternoon. If the data comes exactly as projected, then we don't expect much of a reaction in the market. So other factors may continue driving the market. So remember, we also have the ADP weekly employment change, somehow tentative between 2 and 4:30 p.m. This shows the number of jobs created per week. This is from a private company called Automatic Data Processing. It may have some impact if there's a big variation from the prior reading. But then after this, the main focus will be on the non-farm payrolls. So remember, the non-farm payrolls data comes out every first Friday of the month. But as per the last Friday, we didn't have non-farm payrolls because the BLS, or the Bureau of Labor Statistics, was on leave due to the US government shutdown. This basically means that the data was delayed, and that data will be coming up tomorrow. So tomorrow will be the official non-farm payrolls at 4:30 p.m. So while the market is reacting to retail sales, more focus will be added into the non-farm payrolls, which will be anticipated to bring to show an increase of 66,000 jobs in the US labor market, and that is excluding the farming sector, which would be an uptick from the prior reading, which was 50K. So the unemployment rate is expected to remain the same at 4.4%, whereas the wage growth is expected to be consistent at 0.3% compared to the prior month. So there will also be crude oil inventories from the US side. These are weekly data point at 6:30 p.m. And that's not all. There's a lot more happening on the week. So on one side, we'll be having UK GDP data at 10 a.m. on Thursday. Unemployment claims, these are weekly data point at 4:30 p.m. on Thursday, where we're expecting 222,000 unemployment claims, meaning these are people who are filing for unemployment insurance for the first time. Then the main data point of the week will be the US CPI. So CPI tends to override the non-farm payrolls if inflation is on the rise, and if the job market is worsening, then the NFP tends to override CPI. So both data is happening within the same week, Wednesday and Friday, where we're expecting US inflation to have dropped to 2.5%, down from 2.7%, and this would likely impact the US dollar pairs a lot if inflation was to drop significantly towards 2% target, mainly because we know that there is a change happening at the Fed, where the current Fed chair, Jerome Powell, will be out in May, US President Donald Trump has already nominated a new Fed chair, but then he's yet to be confirmed. Then the official role will be happening in May. So if inflation is dropping significantly, then that will build grounds for a potential rate cut. So far, we don't have grounds for a potential rate cut. So the CPI will be quite informative combined with the non-farm payrolls, since the Fed has a dual mandate on one side to keep inflation around the 2% inflation target, whereas for the job market, the mandate is to maintain full employment. So as per the expectation for the next meeting, which will be happening on the 18th of March, the Fed is expected to hold interest rates steady at the current level of between 3.5% and 3.75%. And the interest rates markets are betting with an 82.3% probability that the Fed will not be cutting interest rates. So as we continue, I'll be checking on the comment section. Remember, this session happens daily at 11 a.m. You can subscribe to the channel, add this to your calendar so that whenever this thing is happening, you'll be able to track back. Good morning, Kiamamuturi. Thank you for joining. I had an issue with Kenya Power, but eventually the guys stand up and now I'm back online. Then we have this comment. So Japan landside victory ushers in a very conservative prime minister. That's Tanae Takaichi. She's the very first female Japanese prime minister. And by having a landslide victory, there is renewed confidence in the Japanese economy, with the Nikkei 225 index hitting a new all-time high, and also the Japanese yen strengthening after the elections on Sunday. So yesterday was pretty good for JPY traders, and today it seems to be continuing. We'll be checking this later on the live analysis session. That is technical analysis. Hello to you too, Chris Perry. Thank you for joining. Can see we also have Robert Cavare. Thank you for joining. We have Methodius Nyamari. Thank you for joining. We also have Zoom classes for those who don't know. So if you're just beginning your trading journey, make sure to check links on our socials to sign up for the Zoom classes, where you get to learn how to trade on a one-on-one basis. And at the same time, you're able to ask questions from our various panel of experts. Then from there, you'll be able to join market analysis sessions on the snapshots at 11 a.m. daily, Monday to Friday. From there, you'll be able to grab market opportunities and make something for yourself. Good morning, Maureen. You can see Paul Keitani, Knight. So also an update on the talks between Iran and the US. They're not progressing so well compared to last week. And as a result, we have some reactions happening in the oil markets. So we'll be checking that later. Other than that, you can see the oil in the house. So good question. Is there a difference in pricing markets on the WTI and Brent oil in real market and the futures market? Yes, there's always a slight difference. Futures markets tend to be ahead of time. So futures tend to have a difference with spot. In most likely cases, the futures markets will be making a move before the spot market. And at the same time, when you compare Brent oil and WTI, they maintain usually a very stable, I would say, spread. Mainly what I would call the cost of moving oil from the US market to the UK market, or UK market to the US market. So that price difference remains very stable. So that's why we have almost 100% correlation between WTI and Brent oil. So Brent oil is much popular because it tends to serve mostly as the global benchmark for oil prices. But then they tend to trend in a similar manner. So good questions. Hello, Derry Musk. So let's move on to the next part of the presentation today. And here I'll be focusing on the top highlights as per Financial News on what's happening in the markets today. So the top highlight here is very simple. This is the sentiment as of today. So President Donald Trump said his pick to lead the Federal Reserve can stop the economy to grow at a rate of 15%. That's too much. It's a bit over-exaggerated. So it's an exceedingly rosy target that nonetheless underscores the pressure that Kevin Walsh will face if confirmed to the role. So on the other side of the world, Australia's consumer sentiment slipped in February after the Reserve Bank became the first major monetary authority to hike its key interest rate this year in an effort to tame the stubbornly strong inflation. So being the first major central bank to hike interest rates, what we have seen as the market reaction, the Australian dollar has become the favorite currency of the year. So since the year started, the strongest currency has been the Australian dollar. So Prime Minister Sanai Takaichi's election victory is handing Chinese leader Xi Jinping a dilemma, whether to engage with Japan's most popular post-war leader or continue a deep freeze with the US top ally in Asia. So clearly, after the elections on Sunday, what we have seen is the market reacting by buying more yen. So the yen has been strong since yesterday, and I expect that to continue for the week. Also, the Nikkei 225 index, which had jumped 3.8% at market open yesterday, is expected to continue showing strength today. So what are the other key highlights as per this morning? So equities extended their climb to an all-time high as a comeback in US technology shares gained traction, alleviating market pressures following concerns about excessive expenditure on AI. So yesterday, what we saw was the dollar index weakening and US equities being on a very strong rally. So whether that will continue today or not is to be discussed. So we'll be doing this on the technical analysis part. So the MSCI All Country World Index, one of the broadest indicators of the equity market, climbed 0.2% to a record as Asian equities surged 1.3% to an all-time high. Powered by tech companies such as SoftBank Group, the rally will be tested later Tuesday, with US and European equity index futures flat after the SP 500 finished near an all-time high on Monday. So in other news, the yuan rose to its highest level since May 2023 after China reportedly directed banks to restrict their holdings of US treasuries. The dollar was barely changed, while gold dipped after 2 days of gains as investors took profits in a volatile market, still looking for a floor after historic lows. So the rises in shares signaled a reduction in fears about the AI trade, which had flared up in the previous 2 weeks, slamming software companies and putting a fog over high-spending tech giants. So while that plays out, traders are waiting for crucial US economic data that will impact expectations for the Fed's interest rate path. Following PM Takaichi's historic election victory over the weekend, the yen rose 0.4% and is still trading around 155 per dollar. Bitcoin fell below 70,000, while the pound remained stable and Starmer solidified his position as the UK Prime Minister. So those are the highlights from that end. Let me see if there's anything else we may have missed as of this morning. Just give me a sec. Yes, the chip shortage continues to drive the stock market investing trends. So the relentless surge in memory chip prices over the past few months has driven a vast divide between winners and losers in the stock market, and investors don't see any end in sight. Companies from game console maker Nintendo to big PC brands like Apple suppliers are seeing shares slump on profitability concerns. Memory producers, meanwhile, are soaring to unprecedented heights. Money managers and analysts are now assessing which firms can best navigate the squeeze by locking in supplies, raising product prices, or redesigning to use less memory. A Bloomberg gauge of global consumer electronics makers is down 10% since the end of September, while a basket of memory makers, including Samsung Electronics, has surged roughly 160%. The question now is how much is priced in. What remains underappreciated is the risk around duration. Current valuations largely factor in the disruption will normalize within 1 or 2 quarters. So as you can see from a stock that we had discussed earlier in the year, that was last month, one of the leading stocks in the memory sector is SanDisk. So if you've ever used a SanDisk, flash disk, or hard disk, Then you know this is a major company in the memory sector, and so far it's up 111.96 year to date. So in the past year, it's up 1,520.56%, meaning that if you had invested in the stock at the same date last year, then your investment would be up 15 times. So this is one of those anomalies where a shortage benefits the stock immensely. So Western Digital is also doing really well, up 1.21% yesterday, and year to date it's up 52.37%. So let's see if there's anything else we may have missed. So on the stock market side, notice that the top US equity indices are all up as of this morning. So from the Dow Jones, SP 500, Nasdaq, the small cap 2000 or the Russell 2000 index, SP 500 VIX is the volatility index, all in the green as of this morning. Canada's stock market index is also in the green. Brazil also doing well. BMV, MSCI World all doing well. The only one that is in the red is the DAX, which is down 0.05%. But overall, we expect positive sentiment in the US and EU stock markets. So lastly, now looking at the currencies, as we mentioned, Sanai Takaichi's election victory over the weekend boosted the yen, and as you can see, the yen is the strongest currency this morning. And you look at other currencies, the dollar is also very strong, but then the Australian dollar seems to be the weakest. But then if you look at the year to date, that is since the year started, the biggest or the top performing currency is the Australian dollar, which is up almost 6% to the dollar. New Zealand dollar is up 5% to the dollar. Swiss franc, which was last year's strongest currency, is up 3.46% to the dollar, whereas the dollar has been the weakest currency since the year started. And then also, it's important to note that the Bitcoin is officially in a bear market, with the year-to-date performance being down 21%, which puts it around almost 50% down. It's actually 40% down from the top all-time high that we saw last year in October. So that means as we enter into the bear market, if you're a Bitcoin buyer, then you should be looking at discounted prices from now on. So trying to see if there's anything else we may have missed. Yes, yesterday the tech sector was really good, but basic materials dominated, up 2.86%. Tech was up 1.64%, whereas the weakest sector was the consumer defensive side in the US stock market. So looking at the year-to-date performance, notice that the tech sector is still in the red, down 0.07%, whereas the biggest gainer has been basic materials, which is up 18.62%, energy 17%, industrials 13%, and consumer defensive stocks up 12.69%. So I'm trying to see if there's anything else we may have missed before we jump right into technical analysis. So Alphabet plans a tech-fast 100-year bond since the dot-com era, which will be mostly dominated by the sterling pound. So now that AIA investments have accelerated, Alphabet has decided to go all out, get into debt, raise money through a special bond, and then use the bond to expand its investments. So big bets happening in Alphabet. We'll be tracking that closely in the oncoming weeks. So that being said, let's now jump into some technical analysis and try to understand what we should be expecting going forward. So this is the MetaTrader 5 trading application, which you can download from FXPesa.com website. It's the app that we use for trading on the desktop as well as laptop. And if you prefer trading using a smartphone, then download Equity Trader by FXPesa. I'll be writing that in the comment section. equity trader by FXPesa. It's available on your Play Store as well as App Store. Make sure to check it out. So the most interesting chart as of this morning seems to be gold. Gold was in a consolidation yesterday. So you'll notice that this was the trend line. So the market was unable to break this particular trend line as per yesterday. Eventually in the afternoon, it managed to break and trade higher before erasing those gains towards midnight. Then today, as of this morning, we have had this another triangle here where the market was unable to break this particular trend line. But then in the last couple of minutes, we have seen gold now breaking again and moving towards the upper side, which implies a likely breakout and continuation higher as we continue extending this rally. So from the daily time frame, this is how it looks like. So after the sharp sell-off that we saw last month, which gave us a 21% drop in gold prices, you'll notice that the market has moved up. So out of a 21% drop, we are still 9.88% lower from the prior all-time high of almost $6,000 per ounce of gold. So clearly, in about 5 trading sessions, we have made more than 50% recovery, and this recovery is expected to continue. So gold seems likely very bullish today, same as silver. So yes, yesterday we had opened pretty positive. We pulled back and then continued moving higher, and then a sharp drop at midnight. And then right now we can see that since the market opened, the market was mostly sideways. But now as we enter the London session, there seems to be a push higher, which means that we are likely to retest yesterday's high on silver. So potential extension of this rally to yesterday's high. And then for gold, we could be hitting yesterday's high or even perhaps exceeding it. So likely short-term target is $5,086 per ounce of gold. So on the other hand, oil markets have been in this form of consolidation. I'm speaking of this area that seems like a triangle. So if you have been observing this, this is more of a sideways market, where we can say for on average, this market was moving this way. So in such a case, we say that the market is consolidating. But then since yesterday, you can see what happened. For a trend line that we were unable to break for a while, the market broke towards the upside, pulled back to the trend line, and then continued higher. So this is a book pattern where we have a consolidation, breakout, retest, and continuation. So of course, for Brent oil, we expect more bullish momentum, with a very short-term target being a high that we had seen on the 4th of Feb. So that is 69.631. And if we breach there, then perhaps now we go for the top, which would be $70.591 per barrel. So on US equity indices, we are still on a very strong recovery. So after virtually trading sideways for a while, I would say for weeks, here you can see that overall, I would say from this period here, if you look at this price action, the one that I've highlighted, and anyone asked you where the market was going, you could easily say this was the momentum here. The market was just moving sideways. So we had the scare last week where the market broke below the support, but that did not last for long. The market bounced immediately, and now we are on a path upwards. So on this path upwards, we expect more bullish momentum. So from the H1 time frame, notice yesterday we had a dip followed by a recovery and a movement higher. So if you go to a smaller time frame and you look at the price action, it's similar to yesterday's drop and then a rally. So today's drop wasn't as much, but then we are seeing some form of bullishness entering this market, where if we say this was the overall momentum, I believe the market is out of that, and now we are seeing buyers coming into this market, attempting to push prices higher. So that's it for the Nasdaq. So we expect at least to beat yesterday's high and move even higher, with a key target around 25,410. The Dow Jones hit a new all-time high yesterday. So from the daily time frame, we are in a territory where there are now candlesticks on the left. And from what I'm seeing here, if this was yesterday's high, and we are looking at the market trading along this line here, then a potential break here would mean that the market accelerates higher. So the break hasn't happened yet. So we are in a kind of situation that we normally describe as a wait and see. So in such kind of a situation, you wait, you see what the market does, and if there's a break, then we move higher. So on the next part, we also look at the SP500, which is very close to a new all-time high. So the all-time high for the SP500 is not very far off. It's $7,013 per share. From the all-time high to the current price, we only down 0.58%. So the market is largely betting that we should be looking at the market hitting a new all-time high after the big scare that we saw here last week. So overall, the market was majorly moving sideways. So for this particular period, we could have said that the market was just moving sideways. But then after the dip here and now the rally, if the drop failed, then the rally is likely to move even higher. So more bets on bullish momentum on the SP500. So Bitcoin is in a 3-day range, moving sideways. So nothing is happening here. So if you're looking for trades, perhaps trade on the break once we get out of the range. But for now, nothing much is happening. And of course, we have had a very strong bearish momentum. So perhaps some recovery could be in play. So looking at other equity indices, the Hang Seng index had a very strong rally as of this morning before erasing all the gains and getting into negative territory. But then it seems to be finding support in what was the Asian sessions high yesterday. So potentially a bounce from here could continue the bullish momentum. Then for the UK 100 index, we were expecting more of a continuation after hitting multiple new all-time highs. So notice what was happening on the daily. So we got into a new all-time high. And then since then, it has been a swing of opposite days. So green day, red day, green day, red day, red day. But then overall, we expect more bullish momentum to persist. So from a smaller time frame perspective, we can already see something is shaping up here. So from the most recent high here, followed by yesterday's high and today's high, there seems to be a trend line that is shaping up along these lines here. Then on the lower side, the market doesn't seem to be forming lower lows. So at some point, we should be expecting some form of break, but overall, it screams more of a consolidation before the next move is made. So Nikkei 25 index are the most bullish market as of this morning. New all-time high at 58,590, and the market is really pushing for that. So right now, you can see that we had this pullback here. The market continued accelerating, and as we speak right now, we are almost filling this gap into a new all-time high and perhaps a breach of that high into a newer high. And given the strong election results that happened on Sunday, notice how the market opened and jumped strongly yesterday at open, 3.86%. And after erasing the gains, we are recovering those gains as of this moment. So more bullish momentum expected in the Nikkei 25 index, whereas the yen is also strengthening. So notice that at market open yesterday, we had a gap. This tends to be a common book pattern, more like an exhaustion gap. And since then, the exhaustion attempted to grab some liquidity here, and immediately the market dropped, showing the yen strengthening against the dollar. This has continued as of this morning, and now we are looking at targets on the lower side. So perhaps more bearish momentum here. So we should be looking at further downside, and this would imply we start targeting 154.368 price level, which is a critical area that was previously serving as support. Dollar Swiss franc continued weakening. So here we are looking at an accelerated bearish momentum. So before I even do that, from the 4-hour time frame, you can see how long we spent in a sideways momentum here. So all this was a range where the market was neither going up or down. Eventually, we broke towards the lower side. And as I mentioned, we normally get a breakout, a retest, continuation. And after we got that, notice that now we had this breakout, retest, continuation. So targets remain on the previous low, 0.76016, and true to the word, it seems like the market is accelerating in that direction. And right now we are retesting yesterday's low, looking to push even lower. So the euro dollar, after spending in this consolidation here, or what we call accumulation, managed to break out yesterday to the bullish side. Then, as of this morning, we are seeing more of a sideways momentum. So it's perhaps wiser to trade on the break, especially if the breakout was to happen after retail sales later this afternoon. So pound USD managed to break this particular trend line. Notice that this was the resistance here. After breaking yesterday, there was a slight pullback as of this morning, but then we should be observing these areas here to see the likely potential breakout. So we don't have that breakout yet, but yesterday's high versus the New York session low could be the determinants for the range, and then a break would inform a potential trade. New Zealand USD also had some form of pullback, some form of consolidation that lasted a couple of days, almost 2 weeks. But then we managed to break towards the upper side, which likely means that now we are headed to the upper part of the pattern, which is 0.60927. So looking at USD CAD, the dollar is weakening to the Canadian dollar. So from the 4-hour time frame, this is how it looks like. So after a strong pump here, got resistance, now we are moving back downwards. With potential targets being 1.35367, which was a previous low here around the month of June last year. So clearly the market is looking to retest the June low around here. Then AUD-USD, strongest currency of the year, currently retesting a key level resistance. So we projected this last week on Thursday, though the dip was a bit deeper. Notice that this was a key level support, some form of liquidity grab here. Then the market bounced really strong, got to the resistance yesterday, and now we should be waiting and seeing, observing for a potential breakout. Remember, we are looking at highs that we haven't seen in recent years. So the last time the market was that high was in 2023 in the month of February, which basically means that this is a 3-year high for the AUD-USD currency pair after their central bank decided to hike interest rates ahead of every other central bank that was in the path of cutting. So on the other hand, we have the dollar index, which has been weak yesterday and today could continue the weakness. Then you look at European equity indices. The DAX is really attempting to recover from the sell-off that we experienced in the last 4 weeks. So clearly testing a key level resistance that it has been unable to break for a while now. So if you zoom out, you'll notice how this area here has been consistent. So a potential break would see us fill the prior gap here. So let's use the forward time frame, and you can see the gap is still unfilled here. So if we breach this resistance, then we are definitely going for 25,300 price level. So EU50 also attempting to breach that resistance. So resistance it was unable to breach for a while, but now it goes into a new all-time high where there is no candlesticks on the left. So clearly, this is a key level test. So once we breach above this, we expect to see more momentum upwards. So the French 40 stock market index for our time frame also making an impressive rally, looking to retrace and get back to its prior high, which is also a new all-time high. So stocks are basically gunning for new all-time highs today. So I think that's enough information to act accordingly. So last thing on my presentation today is that it's very important to understand that gold has been extremely volatile in recent times. So the range candlestick at market open can be tricky. So I know you trade different lot sizes. So if you trade a full lot of gold and then you compare the movement at midnight, then the range between the highest price and the lowest price as per midnight last night was a 1.75% move, which represented $8,898. So in 1 hour, there is a range of $8,898 for a full lot. And that has been quite a pattern. So if you look at the last first 2 hours yesterday, at market open. The range was $7,843 for a full lot. And this is a trend that seems to be repeating over time. So while there are exemptions to some days, some other days are extremely volatile. For instance, you can see this day was 4,639. Look at this other day here. This was $6,427. There's also this other day here. We are looking at $5,403. This other day here, this is $16,151. You keep going that way, then you notice the extreme volatility around midnight. And stand advice, the midnight candlestick in gold is seemingly becoming more volatile, with the first 3 hours of the 29th of January representing $5,599 within those first 3 hours. So while you continue trading gold, beware of the extreme volatility we are seeing shifting from New York open and mostly being focused on the midnight candlestick open. So of course, gold opens an hour later, so that's around 1 a.m. Kenyan time. So that is it from my side for today. I'll be checking if there's any questions I may have missed. If there's none, then I would like to take this moment to thank everyone. Thank you for your time. Thank you for joining the session. And always subscribe. Make sure to leave a comment. And for those who are new to the Bullish Banter podcast, make sure to check out the latest episode where myself and my co-host Jesse Ogola, we discussed why markets are moving on politics and not charts, with US President Donald Trump being the key influencer in the markets. And so far, he has caused out of moves in the markets, especially since last year. And now it has become almost compulsory to follow Trump updates and more content discussed on the podcast. So as always, remember, the session is still happening on the 21st. So if you haven't booked your seats, check the link in the comment section or go to the FXPesa page on X, Instagram, Facebook, TikTok. Also the Bullish Banter handles, as well as the Bullish Banter Telegram community. Check out the links to the event. Sign up. It's a free event. And from there, we'll get to meet, discuss what's up. The event will be at ALX Kenya, Piano Restaurants. So much more will be discussed. Of course, you get the opportunity to network with other traders in the market. That is all for today. Enjoy the rest of your day.